Guys, there are 3 potential undervalued stocks selling at a potentially great discount. Now let's analyze all 3 of these to see which ones are the best buy. I have a feeling these stocks might be lighting up green on the stock analyzer since they recently hit 52-week low. Stock number 1, Dollar General. Guys, this stock is down 40% year to date. Only 18% 1 year, 6 month 47%. Guys, look at this all-time high, $262 back in April of 2022. That is 2.5 years ago. It is down 70% almost. That's a big drop for a company like Dollar General. Now, reason being, they recently came out on their earnings call and they revised guidance. And they said, we're feeling like our consumer is buying based on needs, not on wants, which is kind of interesting because they're already the low-cost seller. So you would think that as we saw with Walmart's same-store sales were up while Target, Home Depot, and Lowe's were down. Now, you might sit there and say, what the heck does Target, Home Depot, and Lowe's have to do with Walmart and Dollar General? Well, my idea was that people go to Target, people go to Home Depot, and people go to Lowe's when they want to do something. They go to Walmart when they need something because they want to save money. I would have thought the same thing about Dollar General, but that isn't necessarily the case. Now, they have plans to open 700 stores this year, which might shock you when I say it's considered a low number. As you can see from their 10K, which I got directly from our website, by year, 1,050, 1,039, 97, and 700 plus. So it's still a declining number of stores, but guys, that's okay. And this, to me, this is one of the negative thesis I see about this company. But I look at it going, so when it was opening a ton of stores, you thought that was going to continue forever? That's what I want to be different in the way in which we think. You have to assume that the best years, as you're smaller, are going to decline. And that's okay. You can still have a great company at a great price with slower growth. This is still a crap ton of stores. 700 stores is still a lot of stores when you have 19,000 stores. In 2023, they just opened their first stores in Mexico, which is probably be a great market for them. So I'm looking at this thinking to myself, okay, here's a stock that's down 60, 70%, which is a great place to start for value. So back to Dollar General. Free cash flow in the last year of $1.7 billion relative to net income. That's great. 5-year average free cash flow of $1.5 billion significantly trails their 5-year net income, though, of $2.15 billion. They pay a handsome dividend. It's really nice now that the stock is down 60, 70%. It's 2.8%. And the best part is it only eats up $500 million of their free cash flow. That's less than a third of last year's free cash flow and almost a little bit over a third of their 5-year average free cash flow. So to me, apart from there being issues with the company, that's a relatively safe dividend. Now, the attractive part, look at this 1-year price of free cash flow of 10.9 and 5-year of 12.5. Huh. Now there's where I look at going, interesting. Very, very interesting. But there's debt in the company because of all their locations. $18 billion market cap, $42 billion enterprise value. That difference right there is essentially their net debt. So my guess is when we go to the 8 pillars here, there's going to be a big fat X on debt. And sure enough, our debt metric is big. Now, does that mean you should avoid it? Not necessarily. You got to sit there and understand, like, they need this debt in order to operate their business. The question is, what are they paying for that space? If they had to exit it, are they going to be able to sublease it? Things like that I would sit there and question. Because if you saw on the number of stores, they close about 100 stores a year. I like the fact that they're aggressive about closing the store and saying, listen, this one's not working out, move on. That's what I like seeing. Some other things, big drop in cash flow in the last 5 years and net income, even though revenue is up $8.4 billion. Okay, so one of the things I want to look at is their same store sales. So if you guys look here, net sales in 2023 increased 2.2%. That's for the entire company. Same store sales only increased 0.2%. Okay? Primarily due to an increase in customer traffic. Average sales per square foot in 2023 was $264. Gross profit decreased 94 basis points. That's 0.94%, primarily due to increased shrinkage and inventory markdown. So guys, they are dealing with the same issues that a lot of retailers have dealt with, but my same thesis with Target, when I was buying Target from 130 down, I said they'll figure out the theft issue. They'll figure out shrink. They'll figure out all these things. And guess what? They're starting to make progress on that. There is no way they're going to allow everybody to steal from them forever. So I look at this saying, is this a temporary problem for Dollar General or is it a permanent one? Because at 10 times free cash flow, it's pretty attractive to take a look at it, okay? So let's immediately right now, let's go to our analyst estimates to see what the analysts are saying about this company. So pretty decent growth, a big drop in earnings per share year over year, but you have a climb back up here to $12.16 in the next 5 years. And revenue growth, 5 or 6%. So I would have thought more revenue growth, but maybe they're being conservative here. But I like the fact they're being more conservative potentially. So let's go to Stock Analyzer tool. Now, guys, if you're new, we have to make assumptions about the future. I'm making 3 assumptions here, low, middle, and high. And what the Stock Analyzer tool does is it tells me based on those assumptions and based on my desired return at the end, what's the price to pay for the stock. Now, keep in mind, guys, it does not include the balance sheet. And the balance sheet here is something to consider because they have so much debt on there. But remember, the debt is probably based on retail leases. Now, if you have our software, you know you can make 3, 2, or 1 number of assumptions. Just hit this drop-down menu, and I'm doing a 10-year analysis. You can do 1 to 20. So I did 3, 5, and 7% revenue growth. I do want to make note. I don't like seeing a declining return on invested capital from 11.5% down to 10.8, down to 8. But revenue growth, low 3, high 7, middle 5. Profit margin, 5.5, 6.25, 7. And free cash flow, significantly lower than their profit margins. So on my numbers that come out, I'm going to focus on free cash flow. 4.25, 4.75, 5.25. PE, I did 13, 15, and 17. Not going to lie to you, I don't know why other than the ROIC and the lack of growth. I mean, that seems reasonable to me to sit there and discount that PE and price of free cash flow for that reason. And finally, this is not my actual desired return, but 9% I put in here to get basically what would it be worth? What's the intrinsic value? What's the market value if I want to match the market in this company? But remember, if you buy individual stocks, you need a margin of safety. You need this desired return to be higher. How much higher? That's according to you. Hit the analyze button. The stock's currently at 83. Guys, look at this. All green. 109 to 211. Guys, there's potential here. If you're in our community, I strongly encourage you, engage people in the community. This is exactly where you need to sit there and grab your attention and say, okay, maybe Dollar General has been beaten up a little too much. Let's take a look at it. Stock number 2, Atkore. This company makes electrical nodes, other electrical things. The interesting part about this company, first off, besides the fact all-time high of $195, and it's currently sitting at $84, over a 50% drop. Year to date, 48% drop. 48% drop year to date. In the last 6 months, 55% of that. It's a big drop, guys. Now, seems like there's pretty good reason for it, and here's what it is. Declining revenue. So you had a big jump in revenue. From over the last, you had 1.8, 1.9, 1.8, 2.93, 3.9, 3.5, and now in the last 12 months, it's been 3.3. So there is declining revenue. So first off the bat is, okay, is the decline in revenue continuing? Is it close to stopping? What's going to make it turn around? This is part of the qualitative analysis you need to do when looking at companies. This is why you're going to be so much further ahead in understanding investing than everybody else just by watching these videos. Because you see a company that's down over 50%, and it should, like I said before, it should be a trigger for you to go, this is interesting, and I want you to be interested in it. But you have to understand why is it down? Because a lot of times stock prices are down for valid reasons. You've got to make sure that you're looking at it from the perspective of, is this temporary? Is it because they had such a big surge that now they're just going back to normal? Perhaps. Let's go check out their net income, their operating income over the last few years as well. This is a great way to look at a company's profitability. 180, 230, 240, 800, 1.2, 900, and now it's 700. So guys, before COVID, they were pretty consistently in the $200 million, $150 to $200 million range. So is this just a fluke until they get back to that level? If so, maybe the stock has further to go. So let's go see what the 8 pillars say about the company. Oh, wow. 8-pillar thriller. I was not expecting this. Oh, look at this PE and price of free cash flow. Oh my gosh. But again, it's based on potentially a really inflated 5-year average free cash flow and 5-year average earnings. So you've got to remember these things and say, is this a permanent fixture for the company? They've bought back a ton of shares. Now, one thing I want to see, are they still generating cash flow on a quarterly basis? Yeah, they still are, guys. Look at these: 73 million, 58, 114, 1. So it's not like it's a company that's not generating cash flow. It is generating this cash flow. So let's look at the analyst estimates. I'm going to go right to the revenue part. So analysts think that we're pretty close to the bottom. 3.26 billion this year, 3.23, and then 3.4. So it's not a big grower, but analysts, granted only 8 of them, believe that we're probably close to the bottom in the revenue, and earnings per share should be evening out here. But guys, if they're right on these earnings per share, you're looking at 5 times, EPS here. That's incredible. I think this company deserves another look, a deeper look. Again, in the community, have a conversation about it. I know that I've seen the ticker Atkore in the community, so make sure you keep talking about it. Now, obviously, if you want to join that community, use these tools, be able to talk to people, go to everythingmoney.com. You see, though, that we have a limited number of daily spots for our software and community. And the reason for that is it's an incredible community. It's an incredible software. We want high quality people using them and getting better every single day. In addition, the community and tools that we have right now include everything we have to offer for retirement, real estate, and stocks. But that's going away soon. And the reason being, behind the scenes, we're going to change this to separate these all out. So the current offer of everything is going away very soon. Now, you may remember when I first started the channel, I was using an Excel sheet with a data feed, and people would always ask, how do I get that Excel sheet? How do I get that software? And I was like, guys, you can't. It's an expensive data feed. You're not going to be able to get it. But it caused us to say, okay, well, how do we give it to people? So we created the software, created the community, and this is software I use every single day for myself. Every single day. Mo uses it every single day. Dalton uses it every single day. But as the channel grows, it's becoming less about me and more about how I can better serve you and the community members, especially as we grow so much. Now, the good news is changes haven't been made yet, but we're working on them every day. So if you join today, you'll be grandfathered in for life with all the data, all the tools, everything we've made so far, and you'll also be able to stay in your pricing tier forever. So if you're serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night and making less emotional decisions, click on the link in the description below to get access to the software. We have a great $7 for 7-day trial. I assure you, it'll be one of the best decisions you've ever made. So let's go back to our stock analyzer. When was the last time I did Atkore? So I did 3%, 5%, and 7% revenue growth. Is that reasonable? I don't know. Maybe it's too high over a 10-year period. Let's be a little more conservative here. Let's call it 2%, 4%, and 6%. Profit margin, I did 10, 14, and 18. And free cash flow, I did the same thing. Now, if you look, the last 5 years, there's been a difference between free cash flow and net income. But in the last 10 years, there's actually been more free cash flow than net income. So I'm going to keep it the same, hoping it goes there. The PE, currently at 5.7, and the price of free cash flow is 7.8. Just to be conservative, I put 10, 13, and 16. But guys, look at these ROICs, over 20%. Maybe I should give it a higher ROIC, a higher multiple here on the PE. Let's say I do 12, 15, and 18. Again, my 9% desired return. So let's analyze this below. Oh boy, look at this. Low price of 115, high price of 346, middle price of 208. Guys, potential big returns if these numbers work out the way I wrote them there, but we don't know the future. But is there enough margin of safety here? Perhaps. Again, have the conversation in the community. Stock number 3, CVS, guys. CVS is quite the business. There's been a lot of struggle lately. Look at the thing that drives me the most crazy about CVS. $82 billion market cap, $243 billion enterprise value. That difference there is that debt. Now, obviously, they have really prime locations and they pay a premium to be in those locations. But look at this drop in free cash flow. The 5-year average of $12.8 billion, last year 5.3. Here's the cool thing. 5-year net income, 6.8. Versus it's almost half of the 5-year free cash flow. So this 5-year price of free cash flow of 6.5. 6.5. Last year's a 15.66. Terrible return on invested capital, much like Walgreens. If you guys remember, if you're one of the original viewers of the channel, I liked Walgreens years ago. I got super lucky and sold it, and it has plummeted since. And the reason being is I hated the debt and I hated the ROIC. And I said, this doesn't fit my long-term goals. Complete and pure luck on that one. This company is currently at $65 a share, all-time high of 113 back in July of 2015. Let's look at the 8 pillars. Oh, it's actually better than I thought. Got big revenue growth, $100 billion revenue growth. Cash flow is down $8.4 billion. Net income's down $1 billion. ROIC is crap. Debt's high, obviously because of retail. Buy back a little bit of shares. 6.4 times free cash flow, 12 times PE. So guys, this is a conundrum for us because you look at these metrics and you say, yeah, this is awesome. But then you got to look at it and say, man, that's a lot of debt. And look at the margins on this business. 5-year average is 2.2%. 1 year is 2%. So it's basically a 2% margin business. It's like a grocery store. I don't know. It might be a screaming deal, but for me, I mean, you look at dividend, people are going to be checking this dividend, almost 4%, and they can afford it. $3.26 billion is their dividend payments off of last year's free cash flow of 5.3 and the 5-year average of 12.8. So if you want this for a dividend, that's fine. I don't know. It's a tough one for me to get around because I just look at that debt. I look at that low ROIC and I think to myself, so where's the upside here? Now you might sit there and say, well, Paul, there's tons of upside. And if something's cheap enough, yeah, something's cheap enough. And like Walgreens, I'm wondering if Walgreens is so cheap because are they being priced in for bankruptcy that probably won't happen? I don't know. This is what makes investing difficult. Because I'm going to show you right now, if we go to analyst estimates, there's growth. 662 to 1060 per share. Revenue, 4 or 5%. This makes me go like, oh, this is a grower. This is great. Now let's go pull up our stock analyzer and figure out what this thing could be worth to us. So guys, here are the assumptions I made for the next 10 years. I did 3, 4.5, and 6% revenue growth. I did 2, 2.25, and 2.5% profit margin. Now guys, free cash flow apart from this year was way higher than the profit margin. So I put 3.75, 4.25, and 4.75. PE, because of a low ROIC and low growth, I put 13, 16, and 19. And again, my 9% desired return. But guys, you definitely need margin of safety on the companies that have low ROICs and low growth. Hit the analyze button, scroll down. 80 to 150, high side of 160 to 304. Boy, makes you think. So guys, you want to watch our last video on 3 stocks near the 52-week low? Watch right here. Thank you very much for your time. I'll see you in the community.